September 19th, 2023. Today we got a measured move down of bars 5, 6, and 7. You can see that's basically where it went to. And a lot of times when you get big spikes on like this on the open, you would think it's going to lead to a trend day, but it generally doesn't. And the reason that it doesn't is because when you get days like this, where the market does trend all day, you can see how it's a lot more sideways in the beginning. And what's happening is, bulls are looking for spots to buy and they keep getting trapped. And when bulls keep getting trapped, that allows the market to get driven lower. And bears, they keep exiting above bars like 10 or 13 or etc. Pick a bar. And when bears keep exiting, they're not able to stay short. And so they keep trapping themselves out. So you have bulls trapped in and bears trapped out. And that's what leads to a trend. Versus something like today, who's buying below 6? Would you ever want to buy below bar 6? No, it's a strong pair of bear, or it's an okay bear bar closing below its midpoint, and then a strong bear bar closing basically on its low on bar 6. And so it's going to be a reasonable swing sell. So traders really probably aren't going to buy below 6. And traders who bought below 1 are now trapped below 6. So those traders are going to be selling. So basically you have bulls and bears are going to be selling to close to 6. And so another way to think of it is everyone who wants to be short is going to be short, and anyone who wants to be out of longs is going to be out of longs. And so that's why it leads to big vacuum tests like 7, where you get a big climactic bar and then some profit taking. Versus on days like this, the market can grind a lot lower. And also, generally, whenever you get a spike on the opening range, you should be extremely, you should immediately be thinking about a measured move. Pretty often, you're going to get a measured move of the spike. You can see here, it was, a big bull spike, and we got a measured move down of the bull spike to here. But sometimes, you can see we got a bull spike and a measured move down. So if it's a spike, if it's a bull spike, it doesn't necessarily mean the measured move is going to be up. And if it's a bear spike, it doesn't necessarily mean the measured move is going to be down. But you could get a measured move in either direction is the important thing to think about. However, when the spike is this strong, it's most likely it's going to be a measured move down. Additionally, we had a leg 1, leg 2 measured move. It's not really that worth looking at, but we did get one. I'm probably sure we got lots of them today, but that is one that we got that I noticed. And generally, when you get a strong sell-off, you have a really hard time breaking strongly above the day's high. So, or when you get, a strong rally, you have a really hard time breaking far below the day's low. So you can see here, we basically had a 2-tick failure during 62. Bar 1, bull bar closing near its high, or closing above its midpoint, but not all that good. Some follow through on bar 2, but probably sellers above 1 since the bar was not that strong. Bar 3, it is a bull micro channel at this point, but to me, it looks like it's going to be 2 legs up and then some sort of correction. I obviously was not expecting this, but, I was expecting basically 2 legs up to 4 and then potentially buyers below 4, or we could go a little bit lower. Some traders will buy below 4 because you're below the moving average and you're buying below a bull bar. So, no bear wants to sell below a bull bar, below the moving average. At this point right here, like if you just on the close of bar 4, the odds of this happening are probably about 10%. So it's really unlikely that you're going to get a huge sell-off. And obviously, as we get bar 5, maybe it increases to 20. You get bar 6, maybe it's 40. Get bar 7, maybe 50, 60, etc. And as it goes, the odds increase. Bar 5, not ideal for bulls who bought below. A lot of them tried to exit around break even, which is basically exactly where 6 got to before we sold off. And you can see 6 sold off pretty strongly and trapped bulls who bought below 5, trapped bulls who bought below 1. And a lot of those traders panicked out and caused the big vacuum test on 7. Additionally, anyone who was looking for an opening swing is going to sell below 6, looking for a measured move down of some sort. And so it's okay to take the short below 6. But a lot of times when you get a big bar like 7, you made 8 points in 5 minutes. It's a 9-point bar, but there's a little tail right here. So you made roughly 8 points in 5 minutes. And I think it's okay to just take the scalp at that point. You basically got a swing profit and you have 0 true risk. So I think a lot of traders are just going to take profits after 7, and that's what causes 8 and 9. It's just profit taking down here. This isn't necessarily bulls buying. This is just bears buying back shorts. It's not quite an inside, but it's a small bar and an inside bar. So it's probably going to act like one, which means there's a 50% chance the first breakout's going to fail. And you can see the breakout below 9 failed on 10. And we got a second leg up. This is basically 2 legs up. It's a 2-legged correction, but you notice it never went always in long. In order for it to go always and long, you probably wanted 10 to close on its high and get some sort of follow through. Like down here, you can see 41 closed on its high, and we got follow through 42, 43. I think 43 is especially important because now you have three strong bull bars closing the other highs. So it's buy the market, buy the close, and traders will just buy. I'll actually talk about what I was about to say when I get there. But anyways, so it never quite went always in long. So some traders who sold and held through 7, 8 and didn't scalp out are still holding short. And when you get 13, those traders will still be short and they might even sell more below 13. Additionally, you can see anyone who bought below 12. Think about how you feel about 13 if you bought below 12. You're extremely disappointed in 13. You wanted buyers below there and to get some sort of reversal up, but not a bear bar closing on its low. That's pretty much a terrible bar for you. And so those bears, to remove that, those bulls who bought below 12 will be selling out below 13, and that's part of what contributes to the big bear bar on 14. Now, something else to pay attention to is our limit order bulls making money. Any bull who bought below 1, not able to make money at any point. You can see that. Any bull who bought below 12, not able to make money. However, bulls who bought below 10 were able to make money during 15 and 16. So if you buy below here, you buy more lower, you're able to get out around break even on your first entry with a profit on your second entry. You could see, say, 1, 2, 3 consecutive sell climaxes to 15, but doesn't close very strong, so I wouldn't take anything there. 17 and 18, bear bars, but there's a very noticeable difference between this, and this. These are small bars, not closing very strong, not breaking out of anything. So these are warnings basically that we're probably going to start going more sideways. Bar 19, outside up bar, but not all that strong. I'd rather wait. And then you get 20. Some traders will look at it as 1 pullback 2, so 2 legs up to bar 20. But 20 is an inside bar, and it's probably an okay swing buy. We're probably not going a whole bunch lower today. So traders who buy above 20 are looking to get back to the 12 close. A lot of traders who are buying there will use a wider stop, like a measured move down maybe, or something like that. And maybe they'll be willing to buy more lower, or they'll just be using a wider stop. The reason being 20 is a really small bar. And when you get really small bars, usually your stop's going to get run. So they'll use a slightly wider stop to increase their probability. Follow through on 21, but it's really not all that good. There's a big tail on the bottom of 20 and 21. And the tail on the bottom of 21, if it's 18 and 19 is 2 legs up, then 20 with the tail, risk of a wedge up on a smaller time frame. So you have to keep that in mind. 22 is a bear bar closing near its low, but you're at the bottom of a developing trading range. Basically 15 to 22 is now a trading range. So probably not many sellers. You can see on 23, we started to get buyers. And basically something to think about is if you bought above 20, you see 21. It's not exactly the bar you want, but it's enough to stay long. And then you get 22. And what are you thinking? You're thinking you're really disappointed. And so your entry price, if you bought above 20, is 4471. And the high of 23 is 4471. Why? Because traders who bought above 20 are disappointed in 22, and they're now exiting at break even during 23. 24 is another reversal up. You're buying the top of a tight trading range, but we're probably going to bounce at some point today. So traders will start taking these types of buys like 24, 33, 40, 41, and eventually one of them is going to work. This is unlikely, but traders are expecting at least a 2-legged minor reversal up to maybe the close of bar 12. The way I was listening in the trading room today, listening to Brad, and the way he put it was traders are fishing. So, you're kind of fishing for the entry that's going to work. Eventually one of them is, and so traders will take a buy like 24. But if you buy above 24, do you want to see 25 and 26? Is that really what you wanted to see? No, not particularly. And so, those traders be disappointed 25, 26, and they'll exit. They're bull bars, but they're not big bull bars closing near their highs. If you buy above 41, this is what you want to see. If you buy above 24, this is not what you want to see buying at the top of the trading range. You want to see better follow through than 25 and 26. Additionally, same thing with 33. 34, okay, that's fine. But then you get 35. You don't want a bear bar here, especially you haven't even been above the moving average yet today. You really don't want a bear bar. And so when you get 35, traders will use 36. You can see anyone who bought above 33 is exiting during the tail on 36. And so those traders who are buying are just scalping out for break even or a tick or two, scalping out again until eventually they get one that works like 41. But anyways, back to 25 and 26, bad follow through for the bulls. And I think bull selling is mainly the cause of 27. but probably buyers below the trading range as well, which causes 28, the buyers. We tried to test back down again, but the market failed twice. And when the market fails to do something twice, it typically tries to go the other way, which it did on 30. Additionally, with 30, it wasn't good at all to buy the close of 26, but it was 3 straight bull closes. So some traders would buy the close, just betting that it's 3 closes and it should be enough for a second leg. But if you're buying the close of 26, you need to have a really wide stop, probably like, I'd say at least a measured move down of this trading range if you're buying that close. And you need to be willing to add on lower below the trading range. And so the traders who buy the close of 26, they add on, below the trading range and they get out during 30 around break even. It doesn't make sense to just buy the close of 26 and hold and then exit at break even. You need to be buying more lower and scaling in. 31, it's an inside bar. Some traders will look at this, this is a sideways pullback basically and hope that 31 goes, but it's unlikely to. You can see on 32, it started to go, but traders just scalped out. And anyone who was selling during 32 is disappointed in this tail. And so when 33 starts to trade down, those traders buy back their shorts around break even, and that's what causes 33. 33 is an okay swing buy as well. You can see this as a potential final flag for the bears. Final flags are often very sideways, and then you get a reversal. Additionally, this reversal is, not at the top of the trading range, so it makes a little more sense to buy. And, the big reason is, you were able to make maybe a point buying above here, exactly a point. So if you bought above 33, you were able to make exactly 1 point. And it's not like great to scalp out for a point, but the point is that, it gives you more time to get out around break even versus this. It's harder to get out around break even than it is so down here. So generally that's why buying lower in trading ranges is better, is because the market's you're going to have more time to make decisions. 35, almost outside down, probably buyers below 34, but I'm not so sure, how much higher we're going to go. If this was strongly bullish, 35 would have been a strong bull bar closing near its high and probably broke above the moving average. Anyone buying in here is hoping we get up here. And so when you get 35, your premise isn't really valid anymore. Hence why those traders scalp out on 36. We get 37 and 38. And, I think bulls exiting below 36 causes 37. Maybe some bears take a chance selling 37, but a lot of them are just going to scalp out on 38, thinking they're lucky to get a quick 3 points. And, bulls will buy this close at 38, betting that bears aren't going to get consecutive closes below, at a new low. I wouldn't do it, but some algorithms are doing that. And that's what causes, 39 is bears scalping out, basically assuming they're not going to get that close at a new low after this final flag. And bulls are going to be buying, assuming that, bears are not going to get that close. And one of the reasons for that is look at all this buying pressure. You have bull bar closing near its high, 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 another one. So you have all these bull bars closing near their highs, and now you're trying to break out to the downside of that trading range. Is that going to work? Probably not. It's more likely that we're going to, go sideways to up for at least, a couple legs and potentially a major correction. So, something to keep in mind is when you're in a trading range so you get a sell off, you get a trading range, and you see all this buying pressure, you should be looking for longs, not really shorts, and expecting that we're going to end up getting a bounce at some point. 40, doji bar. I don't think anyone wants to really buy above the doji bar. There's more likely sellers above, but you're selling at the bottom of a trading range. You're selling above 40, so not ideal. And it essentially ends up being a midday reversal on 41. There's 81 bars in the day, so bar 40 to 42 generally is the window for the midday reversals, and they're relatively common. I have a bunch of examples. Hold on. I went through them earlier. They're not exactly, a lot of them are just reversals roughly around the middle of the day. This isn't today's. A lot of these aren't numbered, but, this is around that window, midday reversal, 40 something, closer to 50, 44 here. But you get the point. There's a lot usually going to be reversals, 38. So you get the point. There's midday reversals generally. And yeah, it's just a pattern to look for around 39 to 42. Just, be aware if you're expecting reversal and it's around that time, that slightly increases the probability that's going to work. That's where I was going with that. 41, bull bar closing near its high, and you get followed through on 42 and 43. When you get 42, it's good for the bulls, but bulls need one more bar because this is a test of the moving average, and generally you're going to have bears selling the moving average. expecting that you're going to get at least a retest to the extreme. And I think that's true that even once you see 43, you could be expecting a retest to the extreme. However, this is 3 straight bull bars and it is by the close. And so it's reasonable to, take the buy above 43, hoping that we continue to rally. And if you get a bear bar closing near its low, just get out. Or additionally, you could scale in lower, expecting that there's going to be buyers at the 40 high because the buyers who bought, the bears who sold above 40 are disappointed in 41 and 42, and they were never let out. You can see here, if you sold above 40, you're stuck in that trade. You never were able to get it, scale in and get out. And so, the ways to manage buying above 43 is if you get a bear bar, you get out, or you buy more around the 40 high and try to scalp out. But, generally, if you start to get a bear bar here, your premise isn't valid that we're going to rally straight up. So I would just get out below a bear bar. One of the ways major trend reversals happen is you get a trend line break and then a retest and then, a bull bar or a strong bull reversal. And you can see that that's basically what bears were trying to get, that retest. They knew bulls were probably going to get the trend reversal ever since we got the trend line break, but a lot of them were hoping for one more move down. And when they, by the time you get 44, 45, bears are worried that we're going to start to bounce even further. And the thing is, you have 5 straight bull bars, so bulls know it's okay to buy. Sorry. Bulls know it's okay to buy, hoping to get to at least the 12 low or maybe the 12 close. And so, that's actually exactly where we got to on 51. And so traders will start to buy, betting that even if we get to go down, we're definitely going to at least get a second leg, potentially a major trend reversal. And if we rally straight up, that's fine too, because you just make a profit that way. And so you can see 46 bounced a little bit, you could see how you got these 3 bars and then it goes a little bit more sideways and then you get a bounce again on, I guess the way to look at it is the trend line. It's like this, trend line like that, trend line steep again. So if that makes sense, it's kind of a parabolic wedge on a smaller time frame, but the point is it's still okay to be long. And that's why we end up getting a pullback, because it's somewhat of a parabolic wedge on a smaller time frame. But this channel is way too tight and is likely to get its own second leg up. It's also a breakout on a higher time frame, so that's something to keep in mind. Probably buyers below 47. You can see during 48 there were buyers, and we ended up getting that second leg up, 49, 50, 51. And then we got a very climactic bar on 52 and 53. At this point, we're probably getting to the 1 low. I think the targets were the 12 close and the 1 low. Traders who bought below 1 should get out at break even, and probably the 4 low as well. And then obviously the high of the day. But traders buying for any reason, scalping out at the 1 low, some algorithms will buy as 52 races up or buy, the close of 53, expecting that we're going to get back to the 1 low. So climactic bar 52, but probably a little higher at least. And some follow through on 53, but you could look at it as 1 pullback 2. So 2 legs up. So maybe a little better to be flat. If I would bought anywhere in here, I would just be flat on the close of 52, to be honest. That's a great place to take windfall profits. And a lot of times you're going to pull back to at least the 12 high, which is the breakout point. Additionally, though, look at bears. I mean, any bear who sold above here, you're trapped. You can make money. If you sold above here, you're trapped. You couldn't make money. If you sold above even, the 45 breakout point or the 47 breakout point, you should have been able to make money. But 50 didn't even get back to the 47 breakout point. So limit order bears literally couldn't even make $1. And so stop order bears weren't even in the market. And so that's driving the market higher. And if you're a bull, you could have bought, the lowest tick, you could have bought the highest tick, you're going to be able to make money pretty much anywhere in here. And that's what creates strong bull trends, is seeing who's making money. 56 is a low 2. After 55 tested the 1 low, we found sellers, which is, pretty expected because, like I said, if you bought below 1, you're disappointed at 6 and 7. So you're probably looking to get out at break even. Additionally, though, when you get a climax like this, you're expecting at least 2 legs sideways to down. And you can see we got essentially 3 pushes down. But bears weren't, again, if you're a limit order bear, you made some money. Maybe you sell above 54, sell a little more higher, you get out during 56. But stop order bulls were not even, or stop order bears weren't really able to make a scalp. Weren't able to get a 1-to-1 of, 56 where your stop has to be, so really difficult for stop order bears to make any money. 61 is a bigger bar than you'd expect, and it's a bit of a surprise. Some traders will buy above it, expecting that 61 is going to get its own second leg. And, when you get 62 going to a new high, a lot of those traders will just scalp out. Again, it's kind of the same deal as over here. When you just get a giant windfall of profit and your true risk is literally 0, just get out. And so those traders will just take their, 9 points, 8, 9 points, just be out of the trade. 63, basically traders taking profits. So bad follow through 63. If it's so strongly bullish on 62, why is 63 disappointing? It's because it's not as strongly bullish as you think. Generally, when you get climaxes, the market will trade back down to the low of the most recent climax and go below its low. You can see here we ended up doing that. And that's probably, if you bought here for any reason, you see 64, you just got to get out below 64. Bears know that they're exiting below. You get follow through 65, 66, back down to that low, and you get a high 2, potential buy above 70, but it's late in the day. I'd rather wait. But, it's notable that if you bought the close of 62, disappointed at 63, you can get out at break even during 64, or those traders will scale in lower, maybe below the bottom of the buy climax, and then get out around here. For always in, it was clearly always in short. It was probably always in short in the gap, but it was clearly always in short when the close of 6. And it probably stayed always in short. I think you have to exit above 20, but it wasn't clear. It was pretty fuzzy in here. It was one of those things where it's like, if you get a stronger follow through bar on 34, it's always in long. But if you get a bigger follow through bar on 37 and 38, it's always in short. It probably was always in short in here, but it can be flipped really quickly. So whenever you think the market can be always in and the market can be flipped by a single bar, you're probably in a trading range. Probably, bears are going to exit above 41, definitely always in long by 44, and stayed always in long until probably below 64, where bulls have to exit. And it's always in short in here. And then probably back to the close of always in long by the close of 72. But tomorrow is FOMC, so we're probably going to get a pretty dramatic move in either direction. The two things that I would say on the daily chart, so we obviously have a bull trend line, and what's either going to happen is you're going to get this high 1, and it's going to get a ton of follow through, and you're going to get a giant bull bar, maybe 50, 60 point bull bar closing somewhere up here that bulls will be extremely happy with, and it'll be trapping bears above this bar. Or you'll get a giant failure and a big bear bar closing near its low, or more likely some sort of trading range bar that continues the confusion. So I realize I just said up, down, or sideways, but that is always, those are always the options. You just kind of have to learn to think, well, if we go up, what is the up going to look like? If we go down, what is the down going to look like? If we go sideways, what is the sideways going to look like? And then when you start to see, if the up is going to be, so let me think of like a better example. So if if you're thinking that we might have to go here, right? If we go up, we're probably going to go here is your thought process. Well, what's it going to look like if we're going to go here? We're in a bull channel. So is it going to rally straight up, or is it going to go more sideways, but, drift up? So you have to be thinking about how you think it's going to get there. And when you see, the market starting to go in the way that you think it's going to towards, that magnet, then you need to get in. Versus if you think it's going to go down, you just need to be thinking about how do you think it's going to go down. And that's kind of the whole basis of trading. But yeah, I think that was it for the 5-minute chart. Stop orders, sub below 6, maybe sub below 7, but you just realize you're going to have to sit through a pullback if you're going to make any money. Probably sub below 13. I think you buy 24. I bought 24 and 33, but I scalped out of both of them at break even. But I didn't buy in here, and I think I probably should have bought. If you're going to buy 33, like I did, I think you got to buy more, buy again on 41, because your premise is still pretty much the exact same. So I think it's a mistake not buying in here, but can't get that upset about the trades you didn't take. Just worry more about the ones you did. Yeah, that's basically it for